India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. We were thinking that the year would wrap up without incident, but incident is what we have on our hands, and a big one. And it's Royal Global Markets. We're talking about, of course, the Fed decision overnight. I'm Prashant. With me, my colleagues Nigel and Reema. Guys, hi, good morning.
Hi, good morning. This is turning out to be quite the turbulent end to the year. Where's Santa?
Well, it looks like Santa's missing in action. And last night till around 11:30 odd, if you looked at the US markets, they were up actually. The Dow was up. And bam, you wake up at around 5 this morning and you see the US markets, have done a total U-turn. 10-session losing streak for the Dow. Yeah. And Powell had a plan of its own, it looks like.
The surprising thing is, and we've discussed this last 2-3 days, that what if, because data lately has been very strong, what if he gently guides the market away from rate cuts in 2025? He did that, and he did it gently, but the market reaction was anything but gentle.
Violent.
So the market reaction was violent and rocky, and actually it spread through wildfire across, macro markets and, all kinds of things. I'll get to that in just a bit from now. But what did the Fed say? Just 4-5 points, which quickly summarizes that. So we got a 25 basis point cut. Don't think we didn't get it, but it was kind of sort of held back, right? There was one sort of voter who was a dissenter. He did not want a rate cut. And it was basically not a unanimous decision. And there were some others who kind of were a soft nose. But there was one outright dissenter, even with the 25 basis point cut that we got. Now, the big surprise for the market, actually not a big surprise because, but I think it's just that the market's done so well, I guess. That's the reaction, really. Surprise, 2 cuts next year versus consensus expectations of 3 cuts. Actually, I'm saying consensus of 3, but some were at 4. That's 4 cuts in 2025. Now you're at 2. Long run Fed funds rate has been revised to 3% from 2.9%. So we all kind of talk about where should the neutral rate be? Is it really going to go back all the way to 2%? Well, guess what? It's moved up a little bit. Core PCE forecast, that's the inflation forecast, will revise up all the way for 2024, 25, 20, all the way until 2027. So inflation up. Unemployment rate forecasts were revised down. For 2024 till 2026. Basically, what the Fed chair essentially is saying that the economy is doing well, much better. So unemployment we're seeing to be low, sustained low. Inflation expected to be slightly stronger, and we need to be cautious. So he stressed that caution is needed when cutting further, given that we are getting close to neutral. If you think about it, this is actually in some ways diametrically opposite to what we saw in September. Because in September, what was the backdrop? It was largely a strong economy, and the Fed cut. What did the market rates do? They went up. After, usually market rates would follow what Fed funds rate is doing, directionally at least. Well, they went in opposite directions. Right now, you've got, once again, a strong economy. Lately, data all has been very strong, but they've decided to pull back in terms of what they will do going into 2025 and beyond. And I think the market, of course, acknowledged that. The market reaction will come up next. S&P down 3%, NASDAQ down about 4%, Russell 2000 about 5% cut. The WIX, the CBOE WIX jumped 74%. We're almost at about 28 levels now. You got the 10-year yield, 11 basis points higher, 4.5% straight there. Actually, across the curve, 2-year, 10, 5, 30, everything went up. Dollar index is now past the 108 levels. So 1%, 1.16% higher to above 108. And look at the currency crosses. There were lots of breaks. The euro, the CNS, that's a Chinese currency, the Brazilian real. You could look at the Japanese yen. And I think there's a Bank of Japan sort of decision which will also come into play. But lots of stuff happened in currency, in rates, in FX, in the stock markets as well. I'll just get 2 levels here. The GIFT Nifty, I'll just put the GIFT Nifty up for a quick bit because that will give you a sense of where we are now. And then I'll just come back to the levels which I want to put out. That's the open. My God. So that's a 330 odd point cut, 23,928. So having said that, let's just put the levels up. So 23,900 is the sort of first support zone. I think we're going to sort of start around there if the GIFT Nifty materializes by 9 o'clock, 9:15. And then you basically, these are nothing, but these are not averages. These are not some indicators. These are basically lows that we had recently, 23,900, where the market actually found some support. And then we had another sort of attempt at a sharp rally from there. And then 23,263, of course, is the lows that we saw 2 months back. Now, the Nifty Bank is, of course, the support here comes in at about 51,353. That is nothing but the 61.8% retracement of the rally that we had on the Nifty Bank from the recent lows to the recent high before it turned down once again. So those are levels. I think it's going to be a bit of defense in that sense. So no point really looking at in the near term what are levels to take out on the upside. The 20-day, of course, is the big one, which broke yesterday, and that seems to be working, that it indicates a short-term kind of a push lower. So a 300-point cut on the GIFT Nifty. Hopefully things improve a little bit, but we'll see. Rima.
Well, and to add to the volatility, today is also the Nifty 50 weekly expiry. Yeah. So markets have been in a downtrend. We've been declining now for the last 3 trading sessions. And so far this week, the Nifty is down close to about 2.5% from its all-time high levels. The Nifty is down nearly 8%. Mid in the small cap index, which was resilient till last week, has also started correcting now. The mid in the small cap index have lost nearly half to 1% so far this week. Big FI selling. So yesterday, the FI sold close to about 1,300 crore in the cash market, taking their 2-day selling to nearly about 2,000 crore rupees, while the DI buying was also very large, 4,000 crore. But despite a net inflow, right, the DIs bought so much more than what the FIs sold, we still had a down day for our markets.
Well, that's right, Rima. You know, and at times the screen reading is telling you the picture, right? You know, last few sessions the Dow has been weak, the Indian markets as well a little bit weakish, and you saw the US dollar was firm and the yields as well were holding firm, which told you that maybe in fact the Fed has a plan of its own and maybe it's not going to go according to script. Mind you, they went ahead and they cut rates, but the commentary clearly was very hawkish, and that's something that equity markets will not like as well. The top 2 cues today, well, the Fed, they have spooked the markets, and also you'll have the Nifty, weekly expiry that will play out. So expect some kind of, of volatility on the back of that. Last 2 expiries as well, we've seen a fair bit of volatility. So I think this time it's going to be no different. That said, a bounce is due, but when it comes about is going to be the question. And also now you have the global picture that's turned a little bit murky. The reason that I say a bounce is due is because the PCR has moved to the lowest that we have seen in the last many months. In fact, I think it could be at the lower end of what we have seen in the last couple of years, at around 0.55 watts. So the PCR has come down to those levels, traditionally from where you do see a bounce. And that's because the call writers, they have been having a blast. You know, 24,300 call, 24,500 call as well, 24,200 call. All of them have seen a fair bit of writing. But on the downside, the 24,000 put, well, that has seen some bit of action. And that's going to be an important mark because in all probability, we start below those levels. What about positioning? Well, the FIs, they moved back to around that 1 lakh contracts odd on the short side. So it was at around 40,000 contracts a few sessions ago. That's moved to a lakh. Clients, well, they are long positions, net long positions, which they were unwinding earlier. It came down to around a lakh contracts odd. Last few trading sessions, it's back to around 2 lakh contracts or thereabouts. So they have been adding some longs as well. Now, moving to the levels that we're looking at. The Nifty at a very crucial juncture. You know, I think this mark is very important. 23,800 to around 23,900. The options data, the 200 DMA, that's the important mark. Otherwise, if you breach this level, then a revisit of the recent low at around 23,200 could pretty much be on the cards. On the upside, well, 24,300 will be the level that you'll be watching out for. The Nifty Bank as well placed very interestingly as we speak. I think the support level comes in at around this 51,500 odd mark, 20 DMA. So we're in a broad range. The markets are, in a bit of a tizzy because the Fed has spooked global markets, but a bounce is something that the street will be looking forward to. And some of those technical indicators, they suggest we're oversold. But let's see whether or not that bounce comes about.
Thank you very much for that. Let's get to the equity calls then this Thursday morning. Jonathan Garner of Morgan Stanley says the Fed delivered a hawkish cut yesterday, indicating further progress is needed on inflation to justify additional easing next year. He says this was a shock to cross-asset pricing, with equities, bonds, gold all significantly weaker, and in particular the Nasdaq among the major US indices. He adds, while it's too soon to say the post-presidential election rally in global equities is ending, he would remind clients of their concerns on valuation and cycle risk, particularly in IT, auto and industrials.
Some more calls coming in. This is Wang of HSBC, who says that the FOMC cut the US policy rate again, but signaled fewer rate cuts in 2025. This likely means a skip in January, no cut in January. He adds that he now forecasts 75 basis point rate cut in 2025, delivered over the next 9 months. He says they continue to look for a strong dollar, see a tug of war in the treasury market, and remain positive on risk assets.